Here's a question most people get wrong. Who actually pays inheritance tax? The common answer is wealthy families with big estates. But that answer is increasingly out of date, and the maths will show you why. Meet a fictional but completely realistic couple. They bought their home in 2005 for around $180,000. It's now worth $480,000. They have some savings and a pension pot between them. Nothing extravagant. They're not rich. They just owned a home in the UK for 20 years. Here's what they may not realize. The inheritance tax nil-rate band, the amount you can pass on tax-free, has been frozen at $325,000 since 2009. That's 17 years without moving. It's confirmed to stay frozen until at least 2031. Meanwhile, average UK house prices have risen by more than 70% over that same period. The threshold has stood completely still, while the value of ordinary homes has climbed right past it. So let's run the actual numbers. Each person in a couple has a nil-rate band of $325,000. There's also a residence nil-rate band of $175,000 available when you leave a home directly to children or grandchildren. Used together by both spouses, that gives a combined shelter of $1 million. So far, this couple is fine. Their estate is well under that. But here's where it gets complicated. That residence nil-rate band starts to taper away once the total estate exceeds $2 million. And this is the part almost nobody knows yet. From April 2027, inherited pension pots will be brought into the scope of inheritance tax. Pensions were previously one of the cleanest ways to pass wealth down the generations. That changes soon. So if our couple has a house worth $480,000, savings, and a combined pension pot of, say, $400,000, their total estate could exceed $880,000. Still under $1 million, but only just. One more decade of property price growth, and that changes entirely. For a single person, the picture is sharper right now. A single person with a $525,000 estate and the full $500,000 combined threshold has $25,000 exposed to inheritance tax at 40%. That's a $10,000 bill on what might simply be a modest home and some savings. So what can actually be done? The most straightforward option is giving assets away during your lifetime. Anything given away becomes fully exempt from inheritance tax if you survive 7 years after making the gift. There are also annual exemptions, $3,000 per year with no conditions, small gifts of up to $250 to any number of people, and if a child gets married, you can give up to $5,000 completely free of IHT. These aren't dramatic, but used consistently over time, they reduce exposure meaningfully. One important correction to a common myth: taper relief does not reduce the value of a large gift. It only reduces the rate of tax applied to it, and only after 3 years. A big gift made 2.5 years before death still counts in full against your threshold. The broader point here isn't about fear, it's about awareness. A tax designed for the wealthiest estates is gradually and quietly catching ordinary families. Understanding the numbers is the first step. What you do with that understanding is, of course, your own decision,